Tony Barbone. I'm going to be hosting the session today. We are going to wait around for about a minute just for a few more people to join us. So we'll kick things off in about a minute's time. So just hang tight. For those latecomers that have just come in, my name's Tony Barbone. I am one of the directors of Private Mortgages Australia. I'm going to be chatting to you about private lending in 2021. So I suppose before we jump into it, I just want to say that 2020 was quite a tumultuous year, had quite a lot of ups and downs. I think we're all very glad to see the back of it. So we've seen, quite a few policy changes that the government has announced during 2020 that's spilling over into this year. And we've got a few changes coming up at the end of the March quarter, which we're going to be talking more about. So let's jump on into it. Okay, so today's session, we're going to be talking about small to medium enterprises or SMEs needs of finance during times of uncertainty. We're going to be looking at the options that are available to your clients when a bank says no, who private lenders are and who they can help. And of course, not all private lenders are created equally, and we're going to be talking a little bit about the PMA way, but not before we talk more about PMA solutions that we've perfected over the last sort of 6 years or so. Okay, so before we jump sort of straight into it, what I want to do is I'm going to be referring to, I'm going to talk a lot about what the banks are doing in the current market. What I really want to do is say that, when I look at private lending, I really like to sort of separate it into two separate camps. So the first camp is what I call the traditional lenders. And traditional lenders are comprised of, big banks, little banks, non-bank institutions, for the likes of your La Trobes and your Liberties and Peppers. So I lump all of them into the traditional lender camp. And then I put private lenders in the other camp. What's left over is the private lending space, or what I call the private lending camp. Okay. Now, the real differentiator between the two camps is that traditional lenders, they look first and foremost at a borrower's serviceability, and then secondly at a security property's value. Now, that's very different to private lenders, where private lenders look first and foremost at the security value and loan to value ratio and the exit strategy. Okay, so just as we jump into it and I refer to banks, I'm also, if I refer to banks, I'm also referring to traditional lenders. Okay, so let's keep moving. So SMEs do have needs during times of uncertainty, and what we're hearing is that the traditional lenders or banks, they are very stretched at the moment. We're hearing that it can take between sort of 4 to 6 weeks for a credit assessor to even look at a loan application for a home loan. It depends on the lender that you go with, but that's the sort of turnaround times we're hearing. And if you sort of consider it from a commercial perspective or a business owner's perspective, 4 to 6 weeks might be the difference between staying or going out of business. Okay, so a very big difference there. So we're seeing that the banks are very stretched. We're seeing that the lending criteria is still currently tight. Lending criteria is set to change though. We're hearing that the government will be changing its responsible lending guidelines, which will be happening at the end of March. And what it is that the government is making softening the Consumer Credit Protection Act so that the lenders are no longer required to make reasonable inquiries into what a borrower puts in their application. So it's really moving the onus away from the lender making reasonable inquiries, and it's putting it onto the borrower, which they have to take some responsibility for what they put in their application. Okay, so this is the government's plan to remove red tape in the system. But I have a feeling that it's actually going to probably put more pressure on the banks and traditional lenders, and we're going to see even longer lead times because we're going to have a huge influx of borrowers looking to get credit in these easy credit conditions. Now, that doesn't really affect private lenders because we tend to work in the commercial credit side of things. So we don't have PMA doesn't have a consumer credit license. We don't have the intention to get a consumer credit license. We don't take into consideration a borrower's serviceability, which I touched on earlier. We are looking primarily at the the security value of the property, the conservative LVR, and of course the exit strategy. Okay. Now, what we saw during times of uncertainty during COVID last year is that some private lenders just said, we're not lending anymore. We saw that happen. Some of the other private lenders that were still lending during the period, they all put their rates up. We're very pleased to announce that PMA did fantastic volumes during 2020, during the midst of COVID. We're very proud that we were open and we're still there to provide solutions to our borrowers that needed it the most. So what we are seeing coming up, of course, is the JobKeeper and the rental assistance scheme that's forecast to come to an end at the end of March. That we see that's probably going to put some pressure onto the market. We're not sure exactly what's going to happen. The other thing the other type of scheme that's out there is we have the homeowner renovation grant. Currently, I think it's $15,000 if you do a substantial renovation on a property over $150,000, or if you're building brand new. It was $25,000 before December. They did extend it, and I have a sneaking suspicion that the government might actually extend a lot of these programs for a further 90 days. I could be wrong, but I think the government is definitely wants to stimulate the economy by using these types of fiscal measures. So, so what does that mean for SMEs? It means things are about to change, and at the end of the day, they're still going to need funds to tide them over. So that's why private lenders exist. So let's keep on moving. So what are the options that are out there when a bank does say no, or perhaps a bank just can't turn around the actual application quick enough to give them a straight answer and they're left in limbo land? So, private lenders, that we're not focused on borrower serviceability, as I mentioned previously. It is still possible. We still take on credit impaired people all the time. What we are looking for is an explanation as to what usually something's happened. There's usually some sort of life event. Something's happened. There's a reason why they stopped paying their bills and they've gone into default. So what we're really looking for is that they're in the process of repairing their credit. And sometimes what we do is we just hold back a certain portion of the loan proceeds and it pays off some of these different amounts. We're looking to create a solution and to allow the borrowers to move forward. Where we differ is we don't look at serviceability. All of our loans come with a component of prepaid or capitalized interest for the term. So the borrowers, if you have a business borrower that has cash flow difficulties, the way our loans work is they can capitalize the loan for say 6 to 12 months and they can pay it out at the end using the exit strategy. Our borrowers really like these characteristics because they don't have to take on the additional debt load, especially if they're having some troubles in terms of cash flow. All of our loans, we live in the real world, and all of our loans do come with monthly extensions, which we find very helpful. Sometimes settlements get delayed by 30 days for whatever reason. So, we don't penalize borrowers when that happens. We merely, allow them to extend the loan out, and that's all agreed up front in the initial offer. We're talking 4 to 6 week turnaround times for a credit assessor. We are very, very proud to recently announced a 4-hour guaranteed response time. So if you make an application online with using our quick app, we will have an offer or a quote back to you within 4 business hours. That's Melbourne time. We're very proud to have recently announced that, and we're seeing some fantastic inquiry responses as a result of that. And settlement within 5 days. So, we provided we get all of the information correct and it's all done. We have a very cooperative borrower that can handle all the information. We can settle it within 5 days. These are some of the options that are available when a bank says no. So let's have a look at some of the different borrower profiles now. So we've found that our the borrowers that we deal with, they are either property investors, property developers, or business owners. Okay, so here's some of the examples that we see time and time again. So we have a business owner just needing an urgent approval. Something's happened. It could be a cost blowout. It could be their business has been shut down by a snap COVID lockdown. We're seeing a bit of that in Melbourne. We have other development projects that have a cost blowout and they need a short-term solution just to get them over the line. We see a lot of developers come to us in order to acquire the land piece. That we do quite a lot of that. As I mentioned earlier, no serviceability. It's not something that we look at. We look at credit impaired people, and we certainly look at people with cash flow issues. Another type of scenario we see all the time is ATO debts. People, it happens all the time. They have a bumper period last year and they've got, they've done really well. The ATO, now it's time for them to pay tax and something's happened and they just haven't got the cash flow there, and the ATO won't give them any further extensions or provide them with a payment plan. So it's sort of, pay up or shut up business really. So we certainly help out people like in this situation all the time. Okay. Another one is we see is value. We help borrowers with valuation, not contract price. This is really quite important when you're dealing with developers. We have developers that purchase properties under, say, like a long 12-month contract, and during that time they go to council and spend countless hours and hundreds of thousands of dollars getting development approvals through. With all the different professionals that they engage, and then there's an uplift in the value. So we understand that. We deal with that situation all the time. And another example is borrowers paying out business partners, which is pretty self-explanatory. So over the last 6 years, we've really we've whittled down what we do best, and we've decided to just leave everything to the other guys out there in that the private lender camp. So this is what we do really well, which is we've sort of split in half. So we've got property solutions, which relate to sort of development, and we've got business solutions, which relate to sort of quick approvals for business owners, and it can be any genuine business purpose. Private Mortgages Australia doesn't have a consumer credit license. We don't do any consumer credit. We don't lend money to mums and dads looking to buy a car or go on holidays. We only provide finance to businesses that have a genuine business need. So this is what we have we split the solutions into these two sides. And we're going to be talking a little bit more about some of these different solutions moving forward. So let's have a look at our loan to value ratio, our LVRs and our pricing. So this did change in light of COVID. When COVID hit, we did actually reduce our loan to value ratios to what we think is very conservative levels. We're probably looking to we review that each quarter, and depending on how the year goes and how these new policies take hold. And how the economy comes back, it's something that we can look at. Now, the other thing is that we, no two deals are exactly the same. No two sponsors are exactly the same. So from our perspective, the way that we look at it is sometimes, if they want to get a higher loan to value ratio, they might have some other security properties there that we can take. So we have it all the time. Someone wants to settle on a development site that they've purchased. They haven't got enough cash to put into it. For whatever reason, and so we take some existing security properties that they have and we put a second mortgage on those, and that frees up the equity for them to get the higher loan to value ratio on the target property. So it sort of turns into more of a blended rate of a blended type of security. So it might be like one first mortgage and two second mortgages. We do that type of thing all the time. So this is our lending process. So what we do is we're very pleased to announce the 4-hour guaranteed response time. So all that one needs to do is go onto our website, fill out the Quick app. It's your borrower client doesn't even need to touch it. They don't have to fill out anything. It just can be as simple as filling out the form online. Our General Manager of Relationships, Shanta, she recently completed a quick app and entered in all the details, and it took her 8 minutes to fill out the form. Okay, so it's very quick. Once we've received the, you filled out the quick app, we'll get a notification. We'll run our initial assessment on the opportunity, and then we'll come back and provide an indicative letter of offer. If we haven't quite got all of the information that we require in order to issue an indicative letter of offer, we'll prepare a quote. Okay, so what it does is it says, okay, this is how much we will lend at this loan to value ratio, and here's the rate. We charge a small assessment fee between $550 and $770 on each application, and that's really there just to cover the cost of our searches. Then, as the referrer, you'll present the indicative letter of offer to your borrower client. Once it's signed off, we get to work. We do all of our due diligence. We prepare a letter of offer, and then we move to settlement, which is the transaction document. So we've really sort of whittled down the process to be as streamlined as possible, because we understand as referrers, you don't want to be mucking around with lots of different systems and things all complicated. We've tried to make it as simple as possible for our referrers. Sorry about that. We've got a little part of the text has been gobbled up here. So our first case study that I want to have a look at today is, if you recall the different solutions that we showed on the previous slide, one of the solutions was equity release first mortgage. So here we had a situation where the sponsor group, they were participating in a retirement village. Okay, so they had a existing first mortgage and a second mortgage on the development project itself. It's quite difficult to source finance for development projects, so they had to go through the private route for this type of development project. So they had an existing first and second mortgage. Something went wrong. They had a massive delay. This was around the time that we had the bushfires at the end of 2019, I think it was. And the sponsor was like, look, if you don't provide me a solution in the next week, they're going to appoint a receiver, and years of hard work is going to basically, they really had a really significant risk of losing their development site and all of the work they put into it and all of the upside in terms of profits, etc. So they came to us and said, we need to turn something around very quickly to inject some more capital into the project. We said, well, what kind of security do you have? They go, well, we want to use the development project itself. We're like, we could do that, but we have to get a valuation report, a QS report. It's a little bit more complex. We can't turn it around for you within a week. They said, well, I've got this property over here in Bondi Beach. It's worth $6 million. They're like, yep, that will do. It's unencumbered. So we put a first mortgage on that for $2 million, very low LVR of 33%. It was just a short-term three-month prepaid loan with 3 monthly extensions. And the rate on that was 9.75%. We turned that around within 5 days. Okay, so we can move very quickly if we have a very cooperating borrower who can provide us with all of the information. And it was just a very simple, easy, bread and butter lend for us. That kind of transaction we can do all day long. So yeah, if the loan were a longer prepaid term, say for 12 months prepaid, we would have done that for a sharper interest rate. This is sort of quite old pricing as well. So this is about 2 years ago, I think we did this transaction. In the current environment, obviously we'd be looking at probably a sharper interest rate as well, but that's because the interest rates have moved significantly since the Reserve Bank announced our historically low interest rate environment. So just to give you an example of, we can move quickly, provided we have all the information, we can turn things around very rapidly. Here's another case study that we have. This one's construction support. We wrote this one about 3 years ago, I think. So if you see the interest rate there, that our interest rates have sort of compressed somewhat in the last couple of years. So that would be more along a tunes of sort of, I think around 18 to 20% would be sort of more in line with our current pricing on that one. But in terms of what this transaction was, the borrower had an existing loan, 80% loan, in Laverton, Victoria, with a planning permit for 3 townhouses. The bank wasn't going to give them enough finance. It was a major that had the existing mortgage in place. They weren't prepared to provide them the finance to do the entire development, and their thinking is that the borrower they didn't have the serviceability to handle the additional debt load. Okay, so the bank didn't have any issues with us coming in as second mortgagee, sitting behind them, and we provided the additional funding for them to complete the project. So yeah, it was a really tidy deal. That one finished up a little while ago. They ended up selling 2 of the properties and retaining 1, and they ended up using the current that same bank to do the refinance. So yeah, it was a really good, very profitable transaction for them, but they just couldn't move forward. They were stuck. And if you think about it, the traditional lenders, they have a certain department in a certain office that handles the sort of the domestic type of borrowing, and the magic number is really like 4. So if it's 4 and under, it tends to stay in the domestic department. If it's like 5 and above, it's more of a commercial. It moves over to the commercial department to do the assessment. And in the commercial department, they have more. They usually have capitalized interest and the like. For the smaller projects, these banks or these traditional lenders look at the serviceability of the borrower, and sometimes they impose restrictions that they want 100% of the project pre-sold. A lot of the developers that we deal with, they know that they're going to probably sell it for a lot less if they have to pre-sell it off the plan. Whereas if they're quite a good sponsor, they understand the market. If they can finish it off, they can usually get a higher price when they speculate in the market. They have to make sure that they're really watching the direction of the market. But sometimes they don't want to lock in, give away profit at a lower price, and therefore they want to look at speculating and completing the project and selling the finished product. Usually you can get more of an emotional buy if they can actually a buyer can go in there and touch and feel and see the project. Okay, so in terms of the valuation, 1.595, the first mortgage with the bank at 842. We did the second mortgage, 274,000, and we ended up doing 70% of the as-if complete value. Okay, so it was a 9-month loan with 3 monthly extensions. As I mentioned earlier, we'd probably do it at a lower rate these days. Okay, so what's the actual cost for private to deal for your client to deal with PMA? Well, it's all on our website. It's all disclosed. It's all pretty straightforward. It just works on a scale. So the larger the loan, the smaller the approval fee. Our approval fee that we collect also includes the referrer fee, the fixed referrer fee. The referrer fee is up to 1%, depending on the fixed referrer fee is up to 1%, depending on the volume of the loan. The assessment fee, now that is between $550 and $770. If it's a very simple one security property, one company, one individual guarantor director, that's going to be on the low side of $550. If it's a development project and very complex, lots of moving parts, lots of properties, the most we'll charge on that is $770. Okay, so we just cover enough for us to pay for our searches. Okay, the legal fees that are charged, that's all it costs. It's done on a flow-through basis. That's just what our transaction solicitors charge. The valuations and QS fees, they're all done at cost as well on a flow-through basis. The way it typically works is once we've got the indicative letter of offer in, we'll go off and we'll get a couple of different valuation and QS quotes as required. We don't always need a valuation or a QS, depending on the nature of the transaction. We usually get a couple of quotes, and then we'll have a review of that, and we will usually use the cheaper of the 2 quotes that we get. Sometimes we just have to pay. We have a special arrangements in place with our valuation firms that pay us that we pay them a premium in order to turn around the valuations within 24, 48 hours. So it really depends on what the transaction is. Sometimes it's not about the cost saving exercise. Sometimes it's about getting it done quickly because the borrower just doesn't have the luxury of time. Okay. We are channel agnostic. And what I mean by that is it doesn't matter if a borrower comes to us directly or they come in via a referrer. The borrowers are always going to pay the same approval fee. Okay, the way that we look at it is that if we have to do the transaction directly, and we are doing all of the work without a referrer, it's going to cost us a little bit more. If we have a referrer, which we encourage, we love working with referrers, we've got an allowance in there for the referral fee. Okay. Just a little tidbit of information. Over 95% of our loans do come via referrers, and we really want to keep it that way. It really is our goal to maintain, our referrer channel. We love working with our trusted referrers, and, we found we do a great job, and they just come back again and again. Okay. So the other thing I should mention as well is that we have the ability to add a service fee into each transaction up to 1%. Okay, that just gets noted in the indicative letter of offer. Or if you want more than the service, if you would like, if it's the transaction a little bit more complex and you as a referrer wants to earn a little bit more on a particular transaction, you can always mandate your client directly, and then provided you disclose the mandate to us up front, we'll take the service fee out, we'll pop the mandate in there, and that will just get dispersed at settlement. Okay, so there's a few different ways that our referrers can make fees here. And then in addition to that, we also have our referral rewards program. Okay, so what that means is based on volume, you'll get we'll send you a gift card based on certain key volume targets, which is pretty handy. Everyone likes to get a nice little gift out of the blue every once in a while. And the other thing I forgot to mention this, the subsequent referral fee. So let's say you refer one of your clients to us. The way we look at it, and it's all in our terms and conditions, is that we consider that client is your client. So you hand over the lead. We do a great job. We settle the loan. You get paid. And now let's say that client comes back again for a subsequent loan. We will do all the work and then just call you up and ask for an invoice and pay you some more money. It's a great way. We've done that numerous occasions. Our referrers love it because they can do pretty much, they just get free money. So it's pretty good. And the way that we have some conditions around that, provided that the borrower doesn't come back with another referrer mandate in place, as long as the borrower hasn't engaged a new referrer, we'll always keep paying that subsequent referral fee. Okay, and it's just another way we like to say thanks to our referrers. So this is what we look at when we're assessing a loan. So this is really important. This is a really important slide, because as a referrer, we want to make sure that you're not wasting time, that you're qualifying transactions. And if you think about what I said up front at the start of this talk, is there's two camps. You got your traditional lender camp, which is big banks, little banks, non-banks, and you got the private lender camp. Okay, if you're bringing one of your clients to us, and they're expecting interest rates that banks charge, there's probably no point in proceeding any further, unless the borrower is prepared to pay. If they've exhausted all of their other options via the traditional route, and then they still need a solution, that's the time to come to us. Okay, if they say, hey, I can get 5% per annum, great, go get 5% per annum. We're not going to be, we don't compete against traditional lenders on price. It's as simple as that. We are more interested in providing a solution that meets the borrower's requirements, that allows them to move forward. Okay, so the first thing we look at is the loan non-coded? We don't have a consumer credit license. We have no intention to get one. We only help genuine business borrowers, developers, and property investors. As long as the credit is non-coded, we can help. Interest rates, our minimum interest rate is 8.95%. If they're looking for 5% per annum, sorry, can't do it, go somewhere else. But if they are interested to proceed on that basis, we could help. We also, one of the first things that we do in our initial assessment is that we look at the postcode and LVR. Okay, so are they looking to borrow 80% loan on rural property in the middle of nowhere? If they are, it's not going to work for us. But if they're looking to borrow 40-50% loan to value ratio in a rural setting, that's something that we could actually have a look at. Okay. Conversely, are they looking to borrow 80% of an as-if complete value on some residential townhouses in Melbourne? 80% is not going to work for us. But if they're looking for 65, 70% of the as if complete value in a major metro location, yeah, that could work. So this is one of the things that we first and foremost look at is the what it is, where it is, and the type of LVR they're hoping to achieve. The exit strategy, this is really key. We don't lend money to people unless they can demonstrate to us that they've contemplated an exit strategy, okay? And the beautiful part about this is if they provide us with an exit strategy, we don't have to review their serviceability, okay? So, a lot of the times accountants haven't got their financials up to date. They want to move forward, they can't. So, traditional lending camp is sort of closed off to them, but they've got a project or some sort of business opportunity that's going to make a lot of sense. It's going to make them could make a lot of profit for them. They want to move forward. They've stacked up, the cost benefit analysis, and it makes sense. Yeah, that's sort of where we come in to help. We always ask up front, why can't they get bank finance? Usually it's serviceability, but it could be credit blemishes, all the things we touched on earlier. And when do you need to settle? If someone needs to settle in 5 days, we need to make sure we're dealing with a cooperative borrower, because we have to sort of drop everything and work on the file. And if they're not towing the line by sending through key documents, it's really going to slow things up. So provided we've got all the information that we request up front, we can move very fast. We can settle within 5 days. Okay. Now, the PMA way. So this is, as I mentioned earlier, not all private lenders are created equally. It's not all about the interest rate. There's a lot more to it than that. Where we differ from other private lenders is we don't charge hefty upfront fees. We've seen it time and time again. I've heard of situations where borrowers have paid $50,000, $70,000 to a private lender who's done some shonky valuations and then said thanks but no thanks, we're not going to lend here, and put borrowers out of pocket. We hate that stuff. So we only ever charge a very low upfront assessment fee. We don't have any teeth in our indicative letter of offer. We don't have charging clauses. We don't have cancellation fees. The way that they work is other private lenders have seen it happen. I won't name names, but what they have is they have clauses in their indicative letter of offer that says that if the loan gets cancelled, they can charge fees. They can put caveats on the properties. We've seen situations where they put a from 1% per calendar month rate, so from 12% per annum, and then they do all of the work. They get the documentation, the solicitors send out the documents go out to the borrower's solicitor, and then they see an interest rate of 3% per annum. 3% per month. And then at that point in time, they go, the lender says, well, if you withdraw now, we're going to put caveats on your property and hold them to ransom until you pay us our cancellation fee. So we can't stand that stuff. There's no teeth in our indicative letter of offer. We do all of our valuations. They're all instructed by us for either fair market value or mortgage security purposes. So we're all done at a reasonable cost. Other private lenders do stuff, get the valuers to kick the valuations in the guts and do forced sale valuations, and more often than not, the actual LVRs don't stack up. All of our legal fees are done on a flow-through basis and all that cost based on what the solicitor charges. This is another really interesting point. We rebate the unused interest on extension payments. So I'll give you an example. So let's say one of your clients come to us and we do a 6-month prepaid loan, and then we have 6 monthly extensions in the loan. Now, let's say the 6 months are used up, and then they pay 1 month's interest in advance at the lower rate. There's no penalties, no fees for doing that. And then they use up, say, they paid 1 month in advance, and then 2 weeks later, they settle. So what we do is we actually rebate the last 2 weeks of interest that they haven't used, because we think that's only fair. So that's something that we do a little bit different. We have custom-built software. We have a full-time programmer who actually is always building our software systems behind the scenes. There's a lot of work that's gone into us being able to deliver a 4-hour response guarantee. Very complicated, but we love this stuff. It's all good. So yeah, we're very proud of that. We have a very high level of repeat customers, which ties in very well with our subsequent referral fee, which we touched on. And we have a win-win approach to lending. We want win-win relationships with our referrers, and we want win-win relationships with our borrowers as well. Okay. So what we're going to do, we're running pretty well on time. what I'm going to do is I'm going to open it up to some questions here. This is all of our new opportunities are assessed by our General Manager of Relationships, which is Shanta Lobo. Here is Shanta's details. Give her a call if you have a scenario, give her a call to spitball a scenario. She loves chatting about them, and she handles sort of all of our quoting, okay? But yeah, I'm happy to open up the floor to some questions if you have any. Let's have a look here. So yeah, if you have any questions, just please type away into the little sidebar. Yeah, haven't got any questions. Okay, well, if there's no questions, guys, look, thank you for attending. We'll ensure that you get, oh, here he goes. What is your max lend per security, max term for development? Yeah, great question. Great question. I don't think I have that. What I will do is we'll go back to, I think we've got it in, here we go. So we'll send you through some of these slides. Now, this is for major metro area, major metro locations. All of these loan to value ratios and rates are here for major metro locations. So in terms of development, at the moment, we're looking sort of around 65%. It depends on the nature of development. So we're doing one at the moment where we've got, I think it's like 6 or 8 townhouses. In that situation, that's more of a development style of transaction. So we'll probably only do a maximum of 65% of the end value. We have recently done transactions where we're doing more of a substantial renovation. And in those circumstances, we've gone up to 70% of the end value. And that's because quite a lot of the house was being retained. So they weren't sort of demolishing and starting from scratch. It was more of a, there was an existing dwelling there in a really quite nice location. They've done a substantial renovation to it, and we've lent on 70% of the as if complete value. So that's quite different to, flattening anything that's there, starting fresh, and putting 6 townhouses there. So if it's that more of a development flavor, that's 65%. If there's still we could go up to 70%. Depends on the situation, depends on the sponsor's background, but around that, I would say around that 65% is probably our maximum in terms of development. Okay, and that's end value, and that's exclusive of GST as well. Is there an accreditation process? There is. It's online. If you jump on our website, there is an accreditation process. We don't like to put the cart before the horse. So if you send us an opportunity, send us a transaction, once we it's part of our process. If you're new and you haven't sent us an opportunity before, when we send out the indicative letter of offer and that gets accepted, that's one of the first things that we do as part of our process. We'll get you onboarded at that point in time. And it's very straightforward. It's just an online form that you fill out to get accredited. And then we just ask we'll do some searches to make sure you've got a valid ABN and all that sort of stuff. See if you're registered for GST. But it's all, and if you do have an aggregator, we need to just make sure we know who the aggregator is as well. But otherwise, it's pretty straightforward. Is the service fee on top of the approval fee? Yes, the service fee is on top of the approval fee. So yes, so we don't charge the service. Sorry. If you want the service fee, then we will put the service fee in up to 1%, and that gets charged in addition to the approval fee. And obviously the approval fee also has the allowance for the fixed referrer fee. Okay, so if we do a $2.5 million loan, we'll charge a 2% approval fee, of which it contains 0.5% for you as the referrer. And let's say you put quite a lot of work in and you want an additional 0.5%, that's fine. We'll just put that in as a service fee. If you want more than 1%, you just have to make sure that your borrower signs your mandate. And let's say it's for 2%, your mandate will go in there instead of the service fee. Okay. Next question I've got, do borrowers have to be a company or is an individual with an ABN okay if the loan is non-credit? That's a really great question. And our understanding of the way that the legislation works is that if it's a company, it's automatically considered to be a non-coded loan. That said, yes, we have dealt with heaps of individual borrowers with an ABN, but what we might do is we definitely need evidence that it's a genuine business purpose. Sometimes we do things, if it's like they need certain invoices paid or certain business expenses paid, we'll often do that at settlement so that we know that it's controlled and it's going directly to pay those things. So there's just, we definitely do lend to borrowers that are individuals. It depends on the situation. There are a few little intricate things, like if it's a trust and they're individuals on a trust and it's an investment property, we can't do that. There's a few little there's a few areas there that we've been advised we can't help because it would be maybe considered coded. But if it's genuine business purpose, don't see any problems with that at all. So we can certainly lend on just an ABN without a company. Let's have a look here. Would PMA consider 280 million loan against rural 800 million valuation? Probably a bit big for us. We max out around 10 million. So that's really in terms of first mortgages, we would probably go up to about 10 million. In terms of second mortgages, about 2 million. So that's the sort of space that we like to operate in. We don't do a great deal of, we do lend on rural locations as a part of our business solutions, but we tend to find that we're doing sort of, I can't remember we've got it in our credit policy. I've just gone blank. I think it's like 100 acres or something like that. We just don't, there's a certain limit that we don't go beyond. But again, it comes down to, what's the sponsor's background? What's the exit strategy? What's the LVR? Do they have additional security? There's a lot of different things that we would like to take into consideration. But for the most part, up to 10 million first mortgage, up to 2 million second mortgage. That's the space that we like to play in. So yeah. Any other questions whilst you've got me? Thank you all for asking questions. I do appreciate that. Thanks for sticking around to the end. A maximum term. Great question. So look, we did one. We did one a little while back. Well, if I had to answer that very quickly, I'd say 3 years. But we did one a little while back, and we did 12 months prepaid with 24 monthly extensions. Okay. So that gives you a bit of an idea. For development projects, we're usually only doing sort of small. Our sweet spot is really the smaller development projects, usually up to 4 townhouses, 4 lots of land for subdivisions. Those projects tend to only be less than 15 months usually. So our average loan is actually 8 months. So it gives you a bit of an idea. Our minimum is 3 months. We won't do a loan less than 3 months, just because it's a lot of work. we don't do sort of, we don't charge on a weekly basis. We charge on a per annum basis. But yeah, I'd say our average loan is 8 months. And for us, a very, very long loan is one where we, for 3 years, 12 months prepaid, 24 monthly extensions, that kind of thing. We could extend out longer on a prepaid term. Yeah, I've got no problems with doing sort of 24 months prepaid, 36 months prepaid. If a borrower wanted to go down that road, yeah, we could certainly entertain that if they don't want to have to service the loan for a period of time. But it depends on what it is, where it is, the LVR, etc. Any other questions? All right, guys. Well, look, thank you all for attending. We'll ensure that you guys get the slides. We'll send out the slides and a little CPD point for you as well. Have a wonderful rest of your week. And if you do have any, I'll just pop Shanta's details up again. If you do want to discuss a scenario, Shanta is the best person to give a call to, or you can send her an email. And if you've got one that you think that's going to fit the bill for us, you can go ahead and just jump onto our website and fill out a quick app, and we'll get you a response within 4 hours. Thanks, everyone. Have a great rest of the week. Cheers.